Welcome to the HMO Property Show. By investors, for investors. Catch us weekly as we discuss all things cash flow positive property investing. Whether you're a seasoned investor, a new landlord, or just curious about property investing, this is the podcast for you. Sponsored by the Co-Living Collective, your trusted partner in creating vibrant and sustainable shared living experiences. Visit us at colivingcollective.com.au to learn more.
Slumlord. I have been called a slumlord on social media, and it must be true because recently we have changed our social media marketing company, and in response to that we are now getting almost 4 times as many leads as we used to get, which is great, but it also means that our content is now getting in front of 5 to 10 times more people than it used to get into, which means the abuse that Mr. Gibb is getting online has increased big time. And part of the role of being in this sort of position and putting yourself out there so that you can grow a business and have impact and get results that other people don't have is you need to put yourself out there, right? You need to have thick skin. But these sort of comments just bounce off me because I've got nothing but pride and confidence in the HMO. So they can call me a slumlord as much as they want. They are just keyboard warriors that have seen an advert, have done no research, and have jumped online and started giving me abuse. And the thing is, going back to my quote, the man in the arena, which is, I'm just going to quickly read it out to your team. It is not the critic who counts, not the man who points out how strong the man stumbles, or where the doer of deeds could have done them better. The credit belongs to the man who is actually in the arena, whose face is marred by dust, sweat and blood, who strives valiantly, who errs, who comes short again and again because there is no effort without error and shortcoming, but who does actually strive to do the deeds, who knows great enthusiasms, the great devotions, who spends himself in a worthy cause, who at the best knows in the end the triumph of high achievement, and who, at the worst, if he fails, at least fails while daring greatly, so that his place shall never be with those cold and timid souls who neither know victory nor defeat. There you go. I have that in front of my desk to remind me that there is a lot of keyboard warriors out there, and at the end of the day, it's only the people that have actually stepped into the arena and done the things that you are even trying to do, or have been on a very similar path to you, are the ones that count, i.e. coaches, mentors, advisors, etc. Because it's very, very easy to jump online and give someone abuse nowadays without actually knowing the context around what they are trying to do. And I even had one guy earlier that a lot of people at the minute are asking me saying, oh, you keep talking about gross figures, but the net figures are totally different. I'm like, well, no shit, man. Gross and net is totally different. Like, let's talk about your gross wage. Are you on 100 grand a year? Do you take home 100 grand a year? No, because the government take 25 to 30% off you. So you take home 65 to 70 grand a year. But you don't tell your mates that. You tell your mates you're on 100 grand a year, don't you? Because you like boasting about the figure that you're earning. So I've started coming back, and not in an aggressive way, in a way where I'm trying to educate the people that are commenting on our Facebook posts. And one guy again, Nishant, I'm going to call you out, brother. He goes, oh, you always say gross rent, man. You always say gross rent. Gross and net are totally different. So I detailed everything out for him. I said, Nishant, I'm going to do this for you. So hopefully it gives you clarity on what the net figure is moving forward. So I did gross rent. $375 a room times 6 gives you this. Take away vacancy, take away property management fees, take away your operating expenses, leave you with this net figure before holding costs. Now let's assume you put a 20% deposit in, which is this much, and you've got an 80% deposit, 80% loan at 6.5% interest only, which is this much, would give you this much cash flow. However, because interest rates are dropping, I'm going to also do the calculation at 5.5%, so I've worked out what his holding costs were at 5.5%, his money in the deal, showed him the cash flow, and then I give him a net figure of cash flow and also a cash on cash return from each one. Now, if someone did that for me, I would have actually thanked them and said, oh, thanks very much. His response was, so I'm spending all this money and all I'm going to make is 14 grand. That's great, man. I was like, mate, you could go spend the same amount of money on a 4x2 in Baldivis and put 14 grand a year into it, lose $14,000, but you can claim it back on tax. Honestly, you just can't help some people, no matter what you say or do for them, you're never going to please them, right? So am I wasting my time by even entertaining these people? I'm kind of entertaining myself at the same point as well, right? Because you've got to do these things. You've got to do these things. But coming back to the whole thesis of today's podcast is slumlord. Are we slumlords or are we having social impact? I don't know if you've been picking up the hints and tips that I've been dropping on the podcast over the last few weeks, including some of the social media posts, but it's been confirmed now. And I've also had confirmation from the fund manager that I'm now allowed to openly speak about what's been going on in the background. So if you stick with me by the end of this podcast, I'm going to reveal to you what has been going on in the last 6 months within the business and where the business and where the HMO co-living asset is going in the next 12 to 60 months. Now, I'm going to make a quick note so I don't forget this. Bear with me, people. Right, I'm not going to do that. Let's go back to slumlord or social impact, right? Because if I was a slumlord, what's just happened in the business and what's going to happen in the business would not be happening if we were slumlords, right? But again, the keyboard warriors are out there in style, right? And they are calling me slumlords, and maybe because their perception of this style of housing is the old rundown share house from the 80s. So, and I appreciate that. Some of them houses, not some of them, but I would say all of them houses in the 80s were absolutely garbage, terrible. No concept, like no thought about how people are going to live, no thought about natural, good lighting, good furniture, community focus and community living. It had been all dark, dingy, cheap furniture, dodgy landlords, cramped rooms, mildew bathrooms, fights over the last rolls of the toilet paper. That's the kind of mental picture that people have when they see shared accommodation. And the amount of investors that we speak to on a weekly basis who say, I'd love to see one of these properties. And I'm like, what would you like to see? Like, what are you hoping to see when you go into these properties? I just want to see how it feels and how it looks and blah, blah, blah. And we take investors through these properties, and the first thing they say is, wow, just like a normal house, isn't it really nice? I could easily live here. Some of them actually say, I could easily move my kids in here. And some of them have. So perception versus the reality is a little bit different, because the HMOs of today, the co-living of today, not just us, there's some really good operators all around the country that are doing this. Joel and Bianca, Mark Baker, Matt and Sahara. I'm going to even put Ian Ugarte in there. He does a good product, right? Although these people can be competition for us, there's so much demand out there. I don't care. As long as people are putting good housing out there, focusing on the tenants, because if you focus on the tenants and make sure they've got good housing, you can charge a good rate for your rooms, which then gets you, as the investor, a return, which is good, unless you call Nishant, and then $14,000 is a shit return. Sorry, mate, I'm not calling you out. So, as you know, if you've been following us for a while, you already know what the houses are that we do. If you're new to the podcast and new to our content, firstly, thank you for following us. I'm going to give you guys a quick rundown about our new builds, the layouts, the light, the space, the comfort, etc. Because every tenant has their own private room and ensuite. So if you've ever stayed at a hotel, you've got a common area downstairs, also known as the foyer, where people can hang out, socialise, have a drink, beer, blah, blah, blah. You then jump in the lift of the hotel and you go onto the floor where your room is, and you walk down a corridor, you walk into your room, and you've got a locked room, private, with an ensuite, etc., and a bed. Some of these hotels have sofas. Some of them have little tables and chairs. Some of them might have a minibar or a fridge. And we offer the exact same thing. Now, not at the level of Crown Towers, obviously, because we're providing affordable housing. But we still give everybody the same level of amenity so that they can stay in their rooms and have privacy and security. But they've also got the advantage of going down into a common area to socialise with other people out there, because social isolation and loneliness is rapidly becoming an epidemic in this country. People are feeling more disconnected than ever. And there's investors out there that are still building 4x2s on the fringes and putting 1 or 2 tenants in there. And we wonder why the world's falling apart. So this isn't 6 people sharing one dodgy bathroom like they used to in the 90s or the 80s. It's independent living with a community element. We include all of the bills, so Wi-Fi, aircon, electric, Cleaners go through and clean the common areas, which is good for the people that live there because the common areas are also clean. Also good for us as a property manager and as a investor because we're getting a set of eyeballs in this property every 2 weeks. It's kind of like a Netflix style package deals where they don't have to stress about bills. They just move in, they connect and they live. And it's a premium rental experience at an affordable rate. Kind of like lifestyle and affordability rolled into one because they're in areas that people want to live. Affordable. Let me just take a step back. I always say ABC. A, they're affordable. Our rooms, even though they've got all of these things in them, they're priced at around a third of what it costs to rent a normal house in that same suburb. B, ABC, affordable, convenient. It's ACC. ABC, affordable. It builds community because you've got 6 people living in there, so it brings back community and it's convenient. These the properties are in places that people want to live at a price they want to pay. Like we brought over 880 something rooms to the market. I can't remember the exact figures. I think it was 883. And we have never held a gun to anybody's head and said, you must stay in this property. Like people are actively choosing this style of housing to live and pay and connect, which kind of undermines the slumlord accusation, isn't it? And then not only are people queuing up to rent these spaces, as long as they're priced right as well, don't forget, we've done a few houses lately and we probably priced them a little bit too high and stayed vacant for a little bit longer than we would have liked. And we brought the prices back down to something a bit realistic, filled them straight away. So as long as it's priced correctly in kind of correspondence is the right word, in line with the rest of the suburb. Because if you can rent a 4x2, or let's say a 3x2 in Morley, for instance, for $700, and you're trying to rent out a room in a share house for $500, you're probably not going to get that figure for it. But if you can rent a 3x1 in Morley for $650 and you can rent a room in Morley for $350 to $375, all bills included, fully furnished, there's a good chance you're going to get that figure for that room. But let's talk about the actual demographic of people that rent these houses, because again, the slumlord, the low socio, like all of these things that people think is not the actual reality. And again, when we've housed as many people of us, although we brought that many rooms to the market, we've been in operation now since 2017 as a property management business. I've been investing in this style of housing since 2015, so that's 10 years now. So we have probably housed over 2,000 people in this style of housing. People move out. Some people use this as a transitional style of housing. They might come in for 12 to 24 months while they save up some money, and then have enough cash to either buy their own place, buy an investment, or move into another house with another person. Some people, unfortunately, might find this is now their long-term way of living. And we're talking like the single people that have come out of marriages and don't have much left because the other side of the marriage got more than them. And we've also got the over 55 female in housing stress, which is the fastest growing demographic of homelessness across the country. They choose safety and affordability. And then we've got professionals. We've got the essential workers, we've got migrants moving from different countries. The demographic of people that we put in these houses is incredible. The people that don't have jobs, that's what social housing's for. We are providing housing for workers that have good jobs, good incomes, and spend 10 to 12 hours a day out the house at work performing their profession. Like, if what we were doing with Inhumane, demand would not be this strong. We would not get this caliber of people renting these rooms at the rates that they do for the length that they do. It's like the demand is the proof of the value of this product that we bring to the market. From the investor's perspective, it's a win-win. So the old model, again, negatively geared, lose money to save tax. Or you can buy an $800,000 property now in Baldivis and it's probably $14,000 a year cash flow positive. You wish. $1,000 a year cash flow negative. You can put a 6x6 in that same suburb for $1.1 million, a little bit more expensive, don't get me wrong, but it'll probably be $14,000 cash flow positive. Let's think about that for a second. $28,000 difference in that same suburb. It costs you a little bit more to put it in there. But if you've got an $800,000 property and you've got a $1.1 million property, they both go up 10%. You make more money with the expensive property because $800,000 going up 10% gives you 80 grand. 1.1 going up 10% gives you $110,000. So you're not only making more positive cash flow, but you're making more capital growth because your property's worth more money. And here's the thing. With the old model as well, it's a win-lose-win, isn't it? So like the bank wins, the investor loses because they're negatively geared, it's affecting the lifestyle. And sometimes the people that live there, let's look at the market right now, people are paying $700 to $750 for a 4x2 in Armadale. So the people that are renting them houses are actually losing out as well. Now, the reason that these 4x2s and 3x2s are so expensive right now is because 70 to 80% of the rental market are singles or couples, but they are 70 to 80% of the rental pool is 3, 4 and 5 bedroom houses. So we've got an upside down marketplace where we've got one or two people looking for rentals and 3, 4 and 5 bedroom houses out there. So if you start bringing 6 bedroom houses to the market, that can free up or house 6 people, which would normally rent 6 3x2s between them. That frees up 6 houses for 6 families to then get access to. Does that make sense? So with the HMO, I believe it's a win-win-win. The investor gets a win. The people that live there get a win because it's affordable and it's fully furnished and it's convenient. And then as a company, we get a win as well because we can make some money from facilitating these deals. And because it's so popular, we can do it at scale. And we can have more impact on the market, which we'll get to in a second. Very simple, isn't it? Money in versus money out. Like, would you set a business up to lose money every week to try and claim it back on tax? No, because you'd have a cash flow issue. And negative gearing only works if you do. If you lose your job, you still need to put your money into that property every single week to cover the shortfall. But if you have a positive cash flow property and you lose your job, that property is still going to spit cash out every single week, every single month, as long as you've got tenants in place, which is very rare that we don't. So we're not exploiting tenants, we're solving 2 problems at once, which is exactly what impact investing is. Investors get better returns, renters get affordable quality housing. It's not actually greedy, it's just a smarter, more sustainable, long-term way of doing things. Excuse me. Now, the social impact from this type of thing is absolutely phenomenal. Western Australia is in a bit of a mess. People can't find houses. It's happening all over the country, by the way. There's over 20,000 people on the Perth social housing waiting list. Government are pulling all these levers, according to John Carey, but they're just not building houses fast enough. And for the houses that they're actually building, it's costing them 3 times as much as what it would cost to do us. So like they're releasing billions of dollars and building like 1,000 homes. Remember that number, $1 billion, 1,000 homes, $1 million a house, right? Which, let's say they're going to house 2 people in every one of them houses, 2,000 people. So we're not just building rooms, we're building futures. So we, like we said earlier, for some of these people, it's a platform for them to rebuild a safe base while they stabilise their finances or their lives. But a slumlord would profit off the misery. They put lots of people in one room, charge them a little bit less, but try and make them feel appreciated for the fact that they've got a roof over their head. And the only thing that they're doing is we profit by solving a problem that the government can't solve on their own because it's too big for the government to fix. They're too clunky, they're too slow. So the truth is, and I believe this, and everybody that's in this space believes this, co-living is the future of housing in Australia, not just Perth, but all across the country. Affordable, flexible, community-driven, and I still think we're at the, specifically in Western Australia, I think Queensland will be the first saturated market for co-living. I've said this many times before, I believe Queensland will be the most saturated market. But Western Australia, we're still well ahead of the curve. There's not many people done it. There's not many people doing it. Everyone's disappeared to different places now. There's a little bit of heat in the market from other groups trying to sell stuff on the fringes, but now it's gone quiet and there's only us doing it, which is great. And co-living is a global, there's stats that you can pull from all over the world, can see how this is trending in an upward direction. It's a lifestyle shift, it's not a band-aid. And if being a slumlord means giving people safe homes, investors positive returns and helping solve the housing crisis, then I'll actually get I'm a slumlord t-shirt and I'm a slumlord cap, because if that's what it is, that is me to a T. But it's not, is it? Because everybody's perception of the reality versus their perception, the perception of what it really is compared to the reality of what it really is different to what the keyboard warriors think. So if you are seeing some negative comments online about what this is, like, do a little bit of research. I always do this every time ads are out there. Everyone's always quick to jump on and start slagging people off, aren't they? But do a bit of research on the companies and see who they are, what they do, etc., etc., etc. Now, getting back to the impact, the HMO Property Co. We set a goal in 2021 to deliver 1,000 rooms to the market. By 2023, we'd done about 450 rooms and we thought we are going to smash a 1,000 room target. So it was actually 1,000 rooms in 10 years. That's what we wanted to do. And in 2.5 years, we'd done half of that. So we actually put a 0 on the end of that, and we said, right, we're going to do 10,000 rooms in 10 years. So by the end of 2031, we want to have delivered or have in the pipeline enough housing to deliver 10,000 rooms to the market. Now, because that was our mission of the business, not to help 1,000 investors create financial freedom, like some of these people say. And believe me, we want to help you guys create financial freedom. But because we put the 10,000 room target out there, it changed the conversation in the business. How do we get 10,000 rooms? And we knew that working with everyday Australian mum and dad investors that we could do it, but it was going to be, was there an easier way? Can we remove the friction of the education and the conviction that we need to give people to invest in this style of housing when it's so different to what they're used to? Can we switch that mindset from negative gearing to positive gearing, one investor at a time? We're having a good crack, don't get me wrong, but it's difficult, it's challenging, because it's just a big mindset shift to change, right? So in our planning days, we were asking the questions like, how can we have more impact? How can we build more houses? And the conversation switched from mum and dad investors to high net worth individuals, family offices, fund managers, and pension funds, etc. Where is the money? Is the question that we kept asking. Because without the money, we can't build the houses. Without the houses, we can't have the impact. And we started, I started reaching out to family offices. I got a list of, I think it was 100 family offices in Western Australia with websites, phone numbers, email addresses, phenomenal list to be fair. And I got this from a guy at the gym. I heard him talking one day, he was talking about business. Asked him what his business was. He was just transitioning out of a business that had been in for 25 years. He was setting up a private equity firm. I said, where do you raise your private equity from? He said, family offices. I said, I'd love to get my hand on a list of family offices. 2 days later, there was an email from him with a list of 100 family offices in my inbox. What a legend. So I started reaching out to these people to see if we could raise any capital. And because our big hairy audacious goal was out there in the universe, I feel like all the doors we knocked on and all the rejection that we got led us to the point of somebody actually reaching out to us. And again, we wanted to get more eyeballs on us, so we made a conscious decision to get some PR, and that's how we ended up in Forbes. That's how we ended up in the Real Estate Times, the CEO Weekly. It's how we ended up in the Western Australian. And when we were in them publications, the right eyeballs seen us. My LinkedIn started going crazy from people that would never normally look at me. And these are people from banking background, etc. And we actually had a company from Sydney reach out to us and say that they were putting a fund together for co-living and they wanted to work with us, which was phenomenal. But what is phenomenal is the way that this has grown over the last 3 to 4 months to the point now where we're literally ready to start drawing down funds and start buying properties for the fund. But let me explain how it's being all put together. These guys reached out, flew over from Sydney, came and met us. We didn't have to tell them much about the business and what we do because they'd seen all of the content that we've been putting out online. They said, we know what you do, We'd love to see some houses in the flesh. Again, perception versus reality. We took them to some houses. They absolutely loved it. They flew back to Sydney. 3 days later, we jumped on a call with them and they said, look, we've got a major pension fund that we're going to be having as a cornerstone investor. And they've committed $50 million. And off that $50 million, we've got to go out and raise some more money, and then we can also layer some debt over the top of that as well. Now, what we then did is we set up a weekly call with these guys because for a pension fund and family offices, etc., to invest into something like this, the level of due diligence that these guys do is phenomenal, to the point where they know my shoe size, my inside leg measurement, and what I had for dinner on Tuesday, the 22nd of June. Like, they want to know everything. Rip us apart. Intrusive. But we've passed the test with flying colours, which is incredible. We jump back on the call, and all of a sudden we've been told that the pension fund has now increased our allocation from 50 million to 80 million, which is phenomenal. But they also said that they can only be 40% of the allocation, or 40% of the equity inside the fund, which means that our guys from Sydney had to go out and raise another 120 million of equity, so that we now have $200 million worth of equity. And then they can layer 60% debt on top of that as well, which is 300 million, which means we have $500 million to deploy into the co-living space over the next 5 years, which, again, is incredible. We're very, very proud of this, and we're looking forward to this journey. It's not going to be easy. There's going to be some hard work that needs to go in there, and we are ready to roll our sleeves up and make this work. And as this has kind of progressed, we've got structures set up, we've got the funds available, we've got the trustee in place, they've set SPVs up to buy all these properties in. It's been an incredible learning curve for me as an individual to see how people at this level operate, how they talk, how they think. The connections that we've now got from this is phenomenal. Like, incredible people, high net worth individuals. The fund managers are super connected. The family offices that are involved in this now are mind blowing. And we jumped back on the call with our guys last week, and they were like, right, oh boys, we should be ready to go next week. By the way, the interest in this has been incredible. Because we've got this pension fund as a cornerstone investor, we think that we're going to be able to raise twice as much as what we originally got. So this could be $1 billion fund. I keep saying to myself, I'm just an electrician from Middlesbrough, the northeast of England, and we're about to embark on the next evolution of the business, which is to deploy that sort of capital into the core living space, because they've seen the track record, they've done the due diligence, they've seen the product, they've seen the property management business, they've met the team, they've got nothing but confidence in this, and we're ready to scale this to the next level. So we're probably going to be expanding into Adelaide, Melbourne and Sydney based off what they're telling us they want us to go to. But first of all, we're going to hit Perth and deploy a lot of this into Perth. So there's going to be a lot of cash purchases out there. There's going to be no bank finance, blocks of land cash, building cash, refinance once they're built. And yeah, our property management business is probably going to 10x in size over the next 5 years, potentially more, and we'll be expanding into different states as well. So if I was a slumlord, none of this would be happening with it, because they would have came over and went, mate, your product is terrible, your management's terrible, the circumstances that these people are living in is terrible, we're not coming anywhere near this with a 10-foot barge pole. But instead they came in, they did their DD, and they went, we love this, we can't wait to do this. And documents are signed, legals are signed, money is available, and we are ready to go, baby. So thank you for joining us on the HMO Property Show. No matter where you are in your journey, just always remember this. This all started with one property. It actually all started with getting educated. But education is not power, it's only potential power. Execution of said education and knowledge is where the real power comes in. And what my wife and I have been incredibly good at is learning something and implementing it and making small mistakes along the way. We've never been perfect, and I'm far from perfect now. But what we are is hardworking, driven, and we'll always look for solutions over the problems, because problems come every day, right? But our role as business owners, as leaders, coaches and mentors of people is to find the solution in every problem. And no matter where you are, if you adopt that mindset, then you can progress forward and you can get into a place where you'd never actually imagined that you'd been before. So I'm Neil Gibb. Thank you for joining me on the HMO Property Show, and join me next week. I should be able to update you on what we've been buying for our fund manager. Every master was once a disaster. Every winner was once a beginner.